All right, let's get right into it. If you're operating at the executive level in regional banking, you already know AI is completely reshaping financial services. But welcome to this explainer, where we're going to set aside the hype for a bit. There are no magic bullet pitches today. Instead, we're going to look directly at the evidence and uncover actionable AI strategies, tailored specifically for emerging markets, SME and MSME banking, and complex cross-border operations. We'll be looking at the structural models that are creating real, measurable value out there right now. So here's our roadmap for today. We're starting with the structural credit gap. Then we'll move into AI and SME lending, explore cross-selling and bank insurance, look at scaling regional operations, and finally, we'll wrap up with explainability and model risk.
Let's start with Section 1, the structural credit gap, challenges in SME banking.
Okay, so to truly understand where AI adds value, we first have to look at the underlying market deficiencies. And the data confirms a pretty stark reality. SMEs consistently pay a steep structural credit premium compared to large corporate borrowers. You might be wondering, why is that? Well, over the last decade, as the cost of capital went up, banks were basically forced to prioritize tighter risk management. Now, you combine the sheer diversity of businesses in the SME sector with a severe lack of granular, reliable data, and traditional risk modeling becomes incredibly complex and, frankly, expensive. Banks simply have to charge a premium to offset the opacity of these borrowers. But to mitigate that premium and actually compete in the SME space, we're seeing a rapid shift in strategic priorities. Looking at the numbers, 64% of bankers point to digitizing documentation as absolutely essential. But notice the next two figures, because this is where it gets interesting. 54% say they need more frequent credit evaluations that incorporate novel data, and half are prioritizing highly detailed client-specific information. So what's the big takeaway for your strategy? Those traditional, static, once-a-year reviews? Yeah, they're dead. Capturing dynamic, real-time data is literally the only way to feed accurate risk models and confidently scale your lending operations without totally breaking your risk parameters.
Moving on to Section 2, AI and SME lending, bridging the data gap.
This is where AI actually steps in to fix those data deficiencies we just talked about, especially for micro, small, and medium enterprises, or MSMEs, operating in rural and agro-business sectors. Think about it. Traditional credit scoring systems routinely exclude these populations simply because they don't have a formal credit history. It's a massive roadblock. But AI-powered predictive analytics can completely bypass this barrier by looking at alternative data. By analyzing things like mobile phone usage patterns, transaction histories, or integrating real-time cash flows, AI effectively replaces that opaque financial history with a highly accurate behavioral footprint. It is a brilliant, evidence-based workaround to confidently extend critical microcredit to the unbanked.
And what's truly fascinating on the ground in emerging markets right now is this dynamic. When banks roll out intuitive digital payment interfaces or mobile apps, they aren't just processing a transaction. They are actively generating the exact data footprint their AI models need to evaluate risk in the future. By helping clients increase their digital footprint, institutions naturally capture the precise data required for credit scoring. It creates this incredibly powerful self-feeding cycle of financial inclusion and economic resilience.
Let's shift gears slightly. Section 3, cross-selling, proactive AI management. As we transition from basic credit scoring into comprehensive relationship management and sophisticated cross-selling, we need to talk about what the industry is calling AI+. Traditional AI was basically a really smart assistant. It passively waited for a relationship manager to manually input a research request before it did any analysis. It was entirely reactive. AI Plus, however, completely flips that paradigm. It assumes agency. It organically changes daily workflows by autonomously initiating outreach campaigns, proactively screening clients and categorizing them for potential bancassurance or future financial needs, often before the client even realizes they need them. And this proactive AI Plus approach, that is the engine behind the AI-powered digital marketplace. Look at Ping An in China, for example. They've built a comprehensive financial ecosystem. Instead of disjointed services, their AI seamlessly integrates banking, health, and insurance into one fluid customer journey. Imagine an agribusiness client securing an AI-approved microloan. The system doesn't just stop and wait for the next request. It instantly and autonomously matches them with the exact crop insurance or health product they might need at that precise moment. That is massive, scalable cross-selling value in action. Which brings us to Section 4, scaling regional ops, architectural needs. Now, if you want to deploy these autonomous ecosystems across multiple sovereign borders, the business case has to be rooted in hard numbers. Let's look at a concrete deployment by KPMG for a regional multilateral bank over in the Singapore and ASPAC region. By acting as an intelligent layer right over top of their legacy systems, a multi-agent AI setup broke down long-standing data silos. The result? Employees reported a staggering 5x gain in productivity. And critically, complex workflows like credit note and contract generation went from taking 4 to 6 hours down to less than 5 minutes per instance. That's a real game changer. But of course, doing that across different countries presents a major structural challenge. To operate globally but comply locally, regional banking groups absolutely need a federated architecture. This basically means deploying your AI tools on a unified platform to maintain global consistency while strictly enforcing local data sovereignty to keep regional regulators happy. Taking an API-first approach allows for modular interoperability. It gives member firms centralized access to headless AI agents, meaning back-end AI tools operating without a front-end interface, so they can work seamlessly without ever violating local geographic data restrictions. Finally, Section 5. Explainability and risk, regulatory scrutiny.
Look, as you scale these capabilities, regulators are aggressively scrutinizing the application of AI, particularly in automated credit decisions. While there isn't one single global law governing this just yet, we are seeing rapidly converging regulatory frameworks. Under GDPR, customers have explicit rights regarding automated decisions. The EU AI Act demands strict transparency obligations. And over in the US, OCC SR 11.7 mandates rigorous model risk management practices. Institutions really have to align with these overlapping benchmarks to ensure their models operate safely and compliantly, especially when assessing more vulnerable SME populations.
So, to meet these rising regulatory demands, the definitive 2026 standard for credit lending dictates a very specific architectural rule. You must cleanly separate the AI scoring engine from the user interface. When an AI evaluates creditworthiness and prices risk, it simply cannot act as an opaque black box. The scoring engine has to return a decision accompanied by clear, auditable reason codes. You absolutely need transparent, defensible logic that both your credit officers and financial regulators can easily unpack and understand. Which brings us to a critical question for your own strategic execution. Can your institution's current AI architecture actually provide the traceable, explainable decision records required to pass tomorrow's regulatory exams? If you're relying on ad hoc, piecemeal AI deployments, the honest answer is probably no. The true value of AI in banking is unlocked not just through flashy innovation, but through robust, auditable governance. Before you scale your next phase of digital lending, formally evaluate your model risk readiness, because in this next era of banking, transparency won't just be a compliance requirement, it's going to be your biggest competitive advantage. Thanks for joining this explainer.